There's actually 3 topics here, I think. Oh, sorry, are coming in around. This one was from Lance. Lance sent me this email the other day. Lance says, Mike, for the next webinar, can you discuss why you would or would not recommend using synthetic stock position in lieu of stock for married put positions if you're trying to get bulletproof? Example, we're just going to go through it, but we're going to talk about it too. A synthetic stock is we have to buy a call and sell a put option. I'll show that on the profit and loss chart. That's a synthetic long stock position. But instead of buying the stock at 12 and doing the married put with a 13 strike put following our rules in the blueprint, we use the synthetic stock position instead and still use that put in that case. Why am I not doing that on a regular basis? All right, fantastic question. Let's go ahead and navigate over to power options, of course. Let me move this over here. Fantastic. Let me open up my questions there so I can see that better. All right. Well, ladies and gentlemen, here we go. Okay. So here, of course, is our power options suite of tools. We're talking about the married put position as described in the blueprint. Preferred structure of buying shares of stock, buying put options, of course, to have a limited downside risk. No worries about the catastrophic events we just discussed there for Lloyd. In that situation, guaranteed limited risk exit, no matter what the stock does, still the potential for upside. But it is capital intensive. Now, I'm just going to go to the married put search very quickly. I'm going to try to isolate a similar example. I didn't get a chance to put a similar example through, direct example. We're going to look for something in our desired price range. So for the question at hand, let's go ahead and first adjust our stock criteria to be between $11 and $15 per share. And I'm going to take out our preferred stock list for the married put default search and open it up to the entire universe. Well, first come, first serve in a sense. Apple Hospitality, no, that's a REIT. They pay a high dividend. I'm going to look for something that's not as high a dividend if possible. This one probably isn't. Let's say with CNX. Okay, so no, Hewlett Packard, perfect. I apologize. Hewlett Packard is a perfect one. All right, so in this example, we're seeing buying shares of stock of HPE at 12.14, buying the August 13 put for a little bit higher risk maybe than we'd like. It shows at 8.4%. If I get midpoint, it might only be about 7%. So let's take a look at the profit and loss chart for this potential married put structure. Buying shares of stock at 12.14, purchasing the August 13 slightly in the money put option for around 198 gives us a risk of $112 or 7.9%. Right? Now, what is this synthetic we're talking about? We're going to hold that there, going to clear that out. We're going to clear out the stock. If I'm doing this, I at least have to go out to August because that's the time frame I'd have with the put. So my synthetic long stock position, buying a call at the money, selling a put at the money, would simulate a long stock position, right? So we have to go to at least August or further. We're just going to stay with August to keep it simple to mimic the stock ownership. All right, so we're going to buy a call at 12. We're going to sell a put at 12. Call slightly in the money, put slightly out of the money, have some reasonable premium here. Just do one contract to keep the math simple, of course. That's your synthetic long stock position. Getting a small net credit, it looks like, of $5. Of course, we'd have to put up the $12, so it's $11.95. Now that we've got our synthetic stock position, we also have to buy the same put we would use. Just wanted to illustrate that that's the long stock position with slightly better cost. We buy the 13 put, and we saw it at about 198, right? That was our midpoint price here, 198. So what am I doing here? I'm not putting up the $1,200 to get the position. In fact, my cost basis is only 193. Just about 1/10 of the capital I'd have to put up into this position. And what do I have? I have a similar risk-reward profile where I've got a 193 cost basis into this 3-leg trade. Essentially, no monetary requirement, of course. What is that? Why is that important? Well, we are in a spread position, aren't we? So this is sort of a bear put debit by buying the 13 and selling the 12 strike put. centered at a slight debit here of 58 cents. That's that one portion, but that 50 cents, of course, is what? That 50-cent debit is just, I'm sorry, 58 cents, my apologies. That 58-cent debit covers the obligation. This 13 put is covering the short put at 12, essentially. So I don't have any extra monetary requirement as a cash secured naked put or as part of a bull put credit spread because it's a higher strike, it's covered. And I've got the cost of 135. So that puts us at our basis of 193. And it gives us similar married put position. Now, the monetary risk in this case is lower, isn't it? My married put was a 112 monetary risk, 100 shares of stock in one put, and a risk of 7.9% of my total capital invested. Here we're risking 48.2% of the 193 debit in this transaction. This is where it starts to become key. You just did one contract of this position, this three-legged trade, and you're risking $93. You say to me, Mike, I'm in a much better structure than you because you've got $1,300, almost $1,400 invested into an HPE married put with a risk of 112. I have $193 into this position with a risk of $93. So I've got a lower risk and a lower capital. This is a superior trade. What is the whole point of the structure of the married put approach? The structure is to control risk, to stack the market odds in your favor, to have single-digit risk. So if I take a loss of 5 or 6%, I only need a 5.3 to 6.5% gain on my next trade to get back to break even. If I take a 48% loss on this trade, I'm going to need a near 100% gain on what I have left to get back to break even. The 193 I invest in this position, I lose 93, need a 93, 94% gain on what I have left to get back to break even. Okay, I understand it. You have a lower monetary risk and you say, no, I'm going to practice proper position sizing. This is only going to represent 3%, 4% of my total portfolio. Okay, so I'm over here with $1,400 invested, a risk of 112. And you open this position with 1/10 of that with a 193 debit, $93 risk, 48.2%. But again, we already talked about your 1/10, maybe a little bit more, 1/11. I'm sorry, not 1/10. Yeah, it's 9 to 1 capital invested, and you have a lower monetary risk. Lance, you and I are in the same position. We're not. I know, Lance, your monetary allocation is much, much higher than mine. I've had discussions with Lance before. That's perfectly fine. But let's say I'm in a position right now where I have $8,000 free capital, and I want to open $8,000 to allocate to married put trades. I put $1,400 into this one with a, let's call it 8% risk. Okay. And now I have, I open a $40 stock. Okay, invest $35 stock. I invest $4,000, and I'm risking another 6% on this married put. And then I open another position here, $26 roughly, $25 stock. So I got $2,600 invested. Okay, and I'm risking 6% on this. Okay, that's the monetary. Yeah, so this might be, you know, this is 112, so this might be, you know, whatever that is, 6%, 150. That's not right, but okay, you get where I'm going with this. And then, of course, the 6% risk here, 210 or something like that. Oh, no, that's way too high. I'm sorry. Yeah, 210, maybe 200. Let's just call it 200. I'm sorry. You have the same 8,000, and you want to mimic some married put positions. Now, you have two choices. You open this position here, and you used 1/8 or 1/9 of the capital. Okay, so that means you're maybe opening another 9 or 10 positions with this $8,000 of free capital that you have. I've got 3 positions, all with single-digit risk. You might open 10 positions, maybe 12 positions with this 8,000, or you do 8 contracts of this position, which means you're now risking $741 on this synthetic position because you've got a 1/8 ratio, and then you open this position with 5 times the contract size, risk of 1,000. and then you do the one here with maybe 6 times that, or you've opened 15 positions, and we have a market turn. What have I lost? 200, 150, 350, $465. Okay, of the 8,000 that I allocated with a full loss, catastrophic market event, as we talked about before, I'm down just the total of these 3 amounts for this position, probably an average of 7 or 8% on my portfolio. This is where investors get trapped, Lance, and I know you practice proper position sizing. I'm not lecturing you. I'm doing this for the general audience out there. The risk of trying to find an alternative against the single-digit risk with the capital intensive that forces you into the ideal size trade, one of the 3 core principles you always hear me talk about. Forcing an ideal size trade, buying the stock and the put forces me to keep single-digit risks. Do I have a low monetary risk here? Absolutely. But it's 48.2% of what I'm investing. And then there's that urge, the urge to splurge that investors have where, oh, I'm only using 1/8 the capital, 1/9 the capital Mike's using. Why don't I do 8 times the amount of contracts, or even 4 times the number of contracts? Well, 4 times the number of contracts, that puts you at a risk of 364, 368, somewhere along those lines. I'm still at 112 monetarily. Okay, this is the slippery slope, the lie of leverage, gambler's ruin that investors get stuck into. This is one of the main reasons why we don't do this personally and why we don't advocate it, Lance. We don't advocate the synthetic to free up the capital. I understand it's a better use, quote unquote, of capital. But the nature of the investor is to overtrade this. You're taking a 48% risk on the position, which doesn't fall into the guidelines of what we're attempting to do, what we're attempting to show with keeping the risk to single digits. Monetary risk we saw in this particular case is lower. It's usually about the same, give or take. That's why it's a synthetic. That's absolutely true. But then the urge to splurge of the investors, oh, well, I can afford to do 4 contracts. I can afford to do 6 contracts. I can afford to open 10 trades as opposed to 3. And if you get trapped in the wrong market situation, you're risking more of your portfolio. You'll see losses that you didn't expect. You're not forcing an ideal size trade. It goes against the general principles. That's why, Lance, we don't advocate and we don't teach using the synthetic stock position in lieu of owning stock. It's also why we don't advocate the other idea of, instead of doing the married put, buying the stock and buying the put, why don't I simulate this by buying an in-the-money call and keeping the same strike put? This creates an in-the-money long strangle position where you're not delta neutral, you're delta opposed. And what does delta opposed mean in this case? It means that whenever I do a comparison of substituting the stock in the married put position for an in-the-money long call trade, instead of fighting 1 time value, you're fighting 2. And we need a much larger movement to the upside before we start seeing profit on the position. And the risk is usually 20 to 30% more. You're usually seeing a risk in the 30, 40% range. Are you using less capital? Yeah, no doubt. 1/3 to 1/4 the capital I'm using for a married put in this situation. But you see the slopes here. You need a larger move upwards before you start getting to break even, because you're not starting delta neutral between the call and the put. You're delta opposed. We need a much larger movement up before the call starts overtaking the loss of the put. You do have the benefit that you can profit to the downside with the in-the-money long strangle. Let me open that graph up so it's easier to see. Sorry, folks. There we go. Okay, it's not going to open up more for me. I apologize. A little bit more. I want to go down here. There you go. But we do have the potential to potentially profit if there is a catastrophic decline here with this in-the-money long strangle. But in the normal married put structure, because the 1 delta of the stock and the delta of the put, as the stock moves up, even if it only moves up 1%, I'm at a 0.5% profit. With the reasonable in-the-money long strangles, whenever we do these comparisons, you need to see a 4, 5, or 6% movement on the stock before you see a profit. 3 to 4% usually, I should say, before you start to see a profit on the strangle position, because you're delta opposed, not delta neutral. And why do I say the term reasonable in the money strangle? Well, the idea, of course, is that you want to simulate and pay less to use this deep in the money long call, and you say, oh, I want a delta of 1, go as deep in the money as possible. Well, the trick is that these options, the 4 strike, the 3 strike, you're using half the capital here. You might have a delta of 0.9 or 0.95, but in reality, there's no activity here. It's much harder to get into. You get the fill price that you want, hopefully, but most likely you're going to pay closer to the ask price. There's lower action, open interest, volume, of course. And then you get experience personal experience when you get that deep in the money on these types of call options. Although you have a delta of 1, they tend to lag the movement. You don't see as rapid movement in these scenarios as you do typically with something that's closer in, has more volume. Yeah, I'd still want to use a delta of 0.6, 0.7, or 0.8, but saying, oh, I want the delta of 1, the deepest in the money, there's no activity here. There's no action there. It's really hard to get filled on those deep in the money positions. And you're still slightly delta opposed, not delta neutral. All right, so because of the lie of leverage, because it doesn't force an ideal size trade, because the nature of investors is to overtrade when they start using leverage, we don't advocate this slants, I should say, because it has the potential to get investors into trouble by overtrading. You've got to greatly practice proper position sizing and more. All right, while I'm here, very quickly, we're just going to take a look at another married put position. We're just going to take a fresh one off the search. I'm going to go to Robert real quick because it's related to married puts. I'm going to stay on married puts for a moment. Then we're going to get to Pete and Kipp. Kipp is actually in the married puts too, so we're going to get to that also. All right, what did I do? I'm going to the search. I'm sorry. Let me go back to the search, and let's go to RadioActive default screen there, sorted by earnings per share growth. Okay, so Robert's question related to married puts is it possible to do the RadioActive strategy without using any techniques that will cap your gains and using only income methods 6, 3, 4, and 9, thus leaving that elemental upside in place? Yes. I mean, the answer is, I'm going to show it a little bit, but the answer, Robert, is yes. You can choose to use or not use any income methods that you want. It is very possible to do that. I have investors, blueprint owners for years, members of Power Options, that will open a married put, and whether the stock goes up or down in 4 days, they'll enter the bear call spread against it, and that's their whole trading plan. And that's it. They don't even adjust the put in some situations, and that's their choice. Okay? It's flexible. You don't have to follow our direct rules, Robert. We show you what we do with these positions. We show you how we approach it in our portfolio. And you and I have talked about that, what we like to do. I love using income method number 4. A lot of my investors don't like doing it. Ernie doesn't like doing it from time to time because he doesn't like paying a debit. He wants to see the income coming in. And as you know, there's a few positions I've had through the years. Well, recent one was DAR. I wish I hadn't sold the call income method number 1 against it. I truly wish. It was right where it should have been. I followed all the rules exactly. I sold the call, and good news came out, and it rocketed up from 56 up to 63, and then to 65, and then to 68, and I had to wait for it to come back down to 65. I was short the 55 strike. You saw that. So I would have much rather been in income method number 6 in that position. Okay, you can pick and choose, Robert, which ones that you want. But income method number 6, I bet you this American Express is probably the best one. We're probably going to have to go 30 days out, Robert, but it is probably going to be the best example. It's a high risk of 7%. Here we are buying shares of stock at 126.14 and buying a July 130 put, the cost of 13.75. Now, it's a 130 strike. We're relatively close to at the money. So what Robert's referring to is there are income methods that work in all market situations. Some of the income methods work best if the stock moves up. The income methods, of course, we're discussing in the blueprint. Some of the income methods work best if the stock is stagnating, maybe 7 or 8, for example. And some work best if the stock falls or you're expecting a fall, 9, 12, 11, not 11 so much, but yeah, 9, 9 and 1, combinations of 9 and 1. 9 and 6 is fun too, Robert. That's always an interesting one. I like to use them from time to time. Okay, but the first thing is why aren't you selling a call right away? And it's because we follow the rules in the blueprint. There's certain rules, and let's give us some time. Go 21 days out in time, why not? And 130, I'm sorry. We'll sell the 130 call. I know earnings are coming up between now and expiration for AXP, which is probably why I wouldn't be selling the call right now to begin with. This is income method number 1. After you've entered the married put, typically we wait for the stock to move up in price, and then we evaluate which one of these bullish income methods would work best. One of the ones is just selling the call against the position. I've taken my risk down from that 7-8% roughly to 5.2, and I've given myself a max 2.6% return if the stock's trading right at the short call strike price at 21 days from now to February expiration. Not that great, okay, but it's not a big move. It's just a 134 points, less than a 4% movement on this $120 stock. We have a 2.6% return, and we lowered our risk to 5.2%. But we likely have earnings, and we're going to have tumultuous markets between now and this expiration date. It could swing. This is what Robert doesn't like. This is what also I don't like when it goes against me, aka the DAR position or some other ones I've had in the past as well. The cure for that, and you covered call traders can use this too, but again, is income method number 6. And income method number 6 is using a bear call credit spread in the stock structure. What's beneficial about that? It doesn't give you as much premium because I have to pay to buy the higher strike call, but it leaves the upside open because it kind of just looks like a covered call with an extra long call position. So if AXP does gap up to 150 or 160 overnight for some unexpected reason, I'm not going back into the negative as I am here with income method number 1. It leaves the upside open, but I'm going to cut this premium by about half. Let's go back to our February 12th expiration. Let's keep it simple. Yeah, 125. Let's keep it simple, just a 5-point spread. Robert, we'll look at the 135 here. It'll be at about half. Okay, so we are going to take about half away from that. We're going to buy it. In the proper structure, that's income method number 6. So it leaves the upside open because, sure, I may have to deliver my shares of stock at the short call strike price, but the upside continues to move up. My long call continues to gain as my put's declining, even though my stock is capped in that position. This is a reasonable position, but what are we facing? Just like you do, you have this gap here. You have this no man's land, for lack of a better term, Robert, between your sold call strike at 130 and your bought strike at 135. I'm sorry, that was a terrible drawing. 135 here. There's our bought strike there. Okay. So what's happening in this situation? As we get closer to expiration, until it goes above 135, we're not gaining any positive delta yet on that long. It's either going to 0 to 1 as we get to expiration. That's what we're seeing here. So in here, we're in no man's land. We still have to pay maybe to buy to close this short call so we don't lose the stock. And we haven't really gotten to the point where it kicks in and starts working for us. And the whole time, the put, of course, is declining as the stock is moving up in those scenarios. But this is a good one because it's a reasonable one, I should say. But if the stock goes up to 135, usually where my target would be for this stock, if I open a married put in the first 20 to 30 days, I'm essentially at very little gain because I have to buy to close this call to avoid losing the stock, and the long hasn't kicked in yet. This is for high momentum positions, obviously. A lot of times in a new married put position, we don't see as favorable of a profit and loss chart when doing income method number 6 right away. What you usually end up seeing is 2 ways to lose. It does something like that. So you're still losing down here. We've cut some of the risk down by 40, 50, 80 cents. And then again, you still have the capped gain here. But because of that no man's land, you can actually have now 2 areas to lose on the position. And this is usually in the target range where we'd expect the stock to go up, which is why we'd open a married put. That's why I don't favor that structure. Right away, Robert. In this, when I see this, when it goes back into the red, I stop analyzing an income method number 6 position. That's not what I want. I want something like this. More preferable is something like this. Okay. where you're still in a reasonable profit range in all aspects with the unlimited upside. But again, to answer your question directly, there's nothing wrong with isolating yourself to just those income methods that leave the upside open. 11 is another one. 5 caps the upside. And I know I'm just using numbers. I'm not going to walk through all the income methods. That's for blueprint owners. Those are the ones who have bought the blueprint. I don't give everything away for free. 5 could be very profitable, but caps the upside. If you've gotten to 11 in your blueprint, Robert, I'm not sure if you have yet, but 11 is essentially if there's an income method number 5 available, you might see an 11, which leaves the upside open like 6, still gives you that extra oomph benefit, the ratio call spread of income method number 5 as well. So what don't I have for you, Robert? What I don't have for you is years of analysis comparing. If I had just opened all of the married puts, the 89 or so married puts I've opened since 2008, would I have performed better if I just used 3, 4, 9, and 6, and maybe 11, and never used income method number 1, 5, 7? I don't have that analysis. I don't have the analysis if I just used 1, 3, and 4 versus if I chose to use 6, 3, and 4 and never use 9. I don't have that. Okay, for each and every one of the positions that I entered. We teach you the 12 different ways that you could potentially adjust a married put position in the blueprint. Really 13, of course, 13 is the do nothing in that scenario. If none of the income methods match my goals, Robert, what I mean is I will do nothing. I'll wait for a better opportunity in that situation. Okay, so that's what we're kind of looking at here. I don't have all of that for you, but you have the freedom to decide which ones work best for you. And a benefit of owning the blueprint, of course, or being a Fusion subscriber, when any of you get into that, after you've gone through the blueprint, you want to check out Fusion for a little bit, is you can go through our past trades and see examples of successful and failed income method number 6s, successful, very successful income method number 5s, and a regrettable income method number 5 I did. That was on Goose, Canadian clothing company. Hated that one almost much as I hated the DAR position. The income method number 1 on DAR, when it gapped essentially from 53, when I sold the 55 call, and it was the right exact setup we would consider for income method number 1, suddenly gapped up to 58. It pulled back to 56. I should have closed it then. I didn't because I still had 20 days to go. And then again, it rocketed to 63, 67, 68, came down to 65, went back to 68. When it got down to 65, I had to pay the $11 or so to close it and roll it up in price. And it's still a favorable position for me right now. But what did I miss, Robert? As you mentioned, the regret of just income method number 1 in those unexpected situations where it gaps. I missed that rise to 68. Okay, it's still around 66, I think, right now, and I'm still in a good married put position. I think I'm short the 70 call with a 65 put, risk of only 4%, max profit of about 6 or 7%. But yeah, it should be higher right now. It should be double digits, and it will be by the time I'm done. Knock on wood, ladies and gentlemen. While I'm here talking about the blueprint, of course, I've got to jump over to RadioActiveTrading.com. And Robert does point out that, of course, since I mentioned that I don't have the analysis on all of my 78, 89 positions and the different combinations, if I'd only use income methods, this, and this versus this, and this on all those positions, that's my homework for the weekend. I don't think my wife's going to agree with you on that, but I will look into some examples potentially over the weekend. All right. In any case, what have we been talking about here? To do a quick ad, we're talking about the blueprint, which is our full discussion on the married put approach and how we use it in our portfolio to control risk to those single digits and use the 12 different income methods as well. I'm here on my account as a blueprint/fusion owner on RadioActiveTrading.com, where we have enhanced education just focused on the married put and blueprint approach, not like Power Options where we support 23 different strategies. But I'm here for Kipp. And Kipp had a question. Let's see here. There we go. Kipp had a question regarding, I thought I may have heard that owners of the blueprint might have access to a different video library. If true, how does one access that? I can always call the office to make this. No, Kipp, it's right here. So, Fusion subscription at RadioActive Trading first, Kipp. I know you didn't ask this. What is the Fusion subscription here? It's a separate subscription from Power Options. Well, there's several dozen lessons that are available for Fusion subscribers to help enhance what's in the blueprint. The open trades and trade tracker. This is where you can follow along with Ernie and my open married put positions. And of course, the track record, you can walk through the briefs and the trade entries I mentioned. For me, since 2008, since Ernie a little bit more. That basic married put report, which looks like the power options search, but you can't change the criteria. And the stock insurance tool, that if you have a stock that's gained in value, you can use that insurance tool. That's also available in power options. For Fusion subscribers, there's lists here for members-only webinars and white papers. And you see things such as 5 ways to milk your radioactive profit machine, playing the bear side of the market, capturing more of your stock's moves, and more. And there's some white papers over here also. Okay, general write-ups. As a blueprint owner, Kipp, Robert, anyone who's a blueprint owner, you can log on to radioactivetrading.com. Don't need to subscribe to Fusion, but as a blueprint owner, you'll have access to this pod down here in the bottom, the Blueprint Owners Only Members section. Blueprint Owner Only Webinars. This is a list of webinars, some similar to what we just saw here in the Members Only section of Fusion, but this is that library you're talking about, the Members Only webinars here at RadioActive Trading. You just have to sign in with the same user ID and password you're using for Power Options. Or that you set up potentially. If you're not in Power Options right now as a blueprint owner, you'll still have a login just to here. This is where also, if you have an older version of the blueprint, you can access any of the PDF updates from your version to our current version, print them out and put them right into your book as well. So what is available there? There's also some other blueprint owners white papers that are available here. So in this menu here, recent ones from last year, Managing Income Method number 1 and 6 and 4, the Time for Income Method number 9, discussion on 12 and number 9, Blueprint Owners Q&A from last year, how to put your blueprint to work, a deeper look at Income Method number 1, 12 income methods in review, playing the bear side of the market we saw in the Fusion subscription, 11, Broken Wing Butterfly I mentioned, Robert, that's there. If 5's available, 11 should be available too. Income Method number 12 video, ways to manage income method number 5. 5 ways to manage income method number 5. More discussion of the original discussion when Kurt developed income method number 11, and that trust the power option stock search with that analysis on the screening criteria and how it compares to others as well. Okay. Okay. Going back to AXP for a moment, real quick, Alberto says, looking at income method number 1, is it best to sell call at the put strike or above? Depends on the movement. You want to be at least at or above. I'm getting, remember in our example here, I'm getting 274, which cut my risk down to 5.2% with a potential here, but it does give me 2 ways to lose. Going higher, Alberto, in the same expiration, what's that going to do to me? That's going to give me lower premium, which means I'm not reducing my risk as much, but I'm going to have more potential upside if the stock reaches that price. All right, so here's the 135 call instead of the 140. I only reduced the risk down to 6.1%. I have a higher potential max return, of course, Alberto, but that's because the stock would be at 135 at February expiration instead of 130. So you ask me, what is it best? What are your goals? Are you focused now on more income to lower the initial at risk, or are you focused on more potential upside growth and not having the stock breach your short call strike price? That right there is the easiest way to determine which call you would sell when the time is right. I never do it right away. We just showed this for Robert as an example between 6 and 1. The AXP was a good one because the put strike price is fairly close and it's a lower volatility, so we can get away with that single digit risk being fairly closer to the stock price itself. Okay, so Alberto, that one is for that as well. In that case, that's the decision-making process. And if further questions, Alberto, you can email me anytime as we discussed today with that other discussion on CCL also. But again, in that case, I apologize again. Yeah, it's sort of that analysis, okay, that we talk about. You see it a little bit in that income method number 1 chapter, Alberto, is that what does the at the money right at the put strike price do? It gives you more premium, the at the money bell curve. So you're reducing the risk to the downside more, but you know you have a slower smaller range for the stock to move before you're breaching that short call strike price. Not as much upside. Not as high as an upside return if the stock's trading at your short call strike price with those 10 profit and loss charts we just showed. Going to the higher strike, don't reduce the risk as much. You're getting less premium, but you've given yourself more upside. For the current market conditions, the SIGA model that's described for each income method. What are your current conditions on your position? What are your expectations in the market going forward? Are you concerned about a pullback, a weakness right now? Maybe you want to go at the money. Do you think we're at a peak? Do you think we're overbought? That'd be a good time to sell sort of an at the money call, wouldn't it? Because if the market falls, you've gotten more premium to reduce your risk further, and the stock pulls back and you're not worried about it. The risk Rob is concerned about is, hey, well, following those rules and I sell the sort of at the money or just slightly out of the money and I have this large gap, I've capped my upside. Can I trade the radioactive just focusing on the income methods that don't cap the upside? The answer is yes. And we just walked through that. You expect less premium upfront using income method number 6 versus 1, but you leave that upside open. But you don't want to use 6 when you graph it, run what we call the catastrophe report, and we see that it enters into a loss to the upside, that you now have 2 ways to lose. That's not the structure that I want either.